One of the most successful ways to invest in the stock market is to find the value of a particular stock and then decide whether or not you want to invest. Once you find the value of a particular stock, you can find if it's overvalued or undervalued, and then from there, it is much easier to make a good investment decision. In this video, we're going to talk about the concept of overvalued stocks, undervalued stocks, how you can identify these different types of stocks and take advantage of the mismatch between the stock price and the market price. And if you stay until the end of the video, I'm going to share with you some very valuable tools and tips that are going to allow you to identify whether a stock is overvalued or undervalued a lot faster. Okay, so to begin the conversation of overvalued stocks versus undervalued stocks, it is very important to talk about the difference between the market price of a particular stock and its intrinsic value. At the end of the day, there's a very real difference between the two of them, and what you should aim to do as an investor is to take advantage of this difference when it's favorable for you and to not let yourself get swayed by whatever emotions or what the market is telling you to do in order to not take advantage of the difference for this. So let me explain to you what this means in more detail. So as you can see, we have a very useful graph right here. So here we have the value of the shares. So this could be known as the market price. So for example, the market price here would be 0, here would be whatever number you want to put, like let's say $100 per share, and then here on the other side of the axis we have the time. So over time, if you pick a really good company, what tends to happen is that as the fundamentals of that company, so for example its earnings, free cash flow, revenues, etc., begin to improve over time as the company makes gradual improvements in its operations, so will the intrinsic value of a company. If a company makes more money, generates more cash flows, this is also going to allow the value of the company to expand over time. And what you see right here is the market price of the company. So this is the price at which the stock or the security is currently trading at. So as you can see, over time this can really fluctuate, and you can see a real difference between the intrinsic value of a company and the market price. So here in this case, the market price is very high relative to the intrinsic value. So you wouldn't want to buy at this price here, but what you would want to do is to buy right here on this buy zone. And the reason why you want to buy in this buy zones is because, as you can see, the market price is low and you have a margin of safety. That means there's a good difference and a good margin between the intrinsic value of that particular company and the current market price. So this gives you a buffer so that in case that your assumptions are wrong, and let's say the intrinsic value of the company is lower, like imagine there's like a line here, you will still be able to make a good return of your investment. But if you buy right here, right at the intrinsic market, it's gonna be hard to make a good return on your investment, and this is why you need to be aware of this. So now what I'm gonna share with you is the different ways in which you could look at this relationship and take advantage so that you can buy in these situations when the market price is low and the intrinsic value of a company is high. A key concept in order to really understand when a stock is overvalued or undervalued is stock valuation. And this is the art of determining the actual value of a particular company based on its financial results that you project into the future and also that you've analyzed from the past. One of the most typical ways to analyze a company is to use a discounted cash flow or a DCF. So as you can see right here, we have a DCF template, and we have many videos on our channel that you can check out on different valuation methods. I'm just gonna show you two of them here so that way you get the idea. With this template, what you could do is just enter whatever company you're trying to analyze and value. And in this case, what you will see is using these functions right here, you're gonna get all the historical data, which is gonna come very handy because once you have the historical data, you can use this data plus some other market reports and analyst estimates and whatnot to be able to project the financial results of that company into the future. Now, your projections don't have to be extremely accurate. In fact, it is better to be approximately right than precisely wrong, as Warren Buffett says. So here you make your projections. In this case, these are just based on averages, which is not a good method to use, but this is just an example here. In this case, you could enter whatever number you like. like, and then you will see the projection being made. Here's the formula for this. And then from there, from those projections, then the cash flows of the company would be made, which you can see right here. We have the EBITDA and then we have the free cash flow. Then this number is calculated to the present value. So this means the actual value of that company right now. For that, you obviously need a discount rate, which in this case, this is what the discount rate is. And then after that, you get the share price of a particular stock, and then you can compare it with the market value. So as you can see, the market value is right here. The intrinsic value in this case, based on the numbers that we've entered that are probably very inaccurate, is this. So in this case, this is the upside. So if you look back at this graph, if these numbers were to be correct for Microsoft, in this case, the market price is low, the intrinsic value of the company is high, and therefore this represents a good buying opportunity. However, like I said before, it really depends on the assumptions and the research that you do. But with this templates, this really helps because you don't have to collect all the data and you can see it all at once to make your analysis process easier. So that's the general idea of a DCF. If you want to see more dedicated videos on this, we have videos that you can check out on our channel. Now what I want to do is show you how you would do this using another valuation model. So here we have the earnings power value model. This is a very common valuation model that is used by analysts and investors all over the world. And so the way that this template works is very simple. Again, you can just change the company ticker. So we'll change it to Microsoft again. You can enter a WACC. We have videos on how it is that you can calculate the WACC, or you can also Google this number. And then using, again, Y-Sheets formulas, which by the way, Y-Sheets is an add-on that you can install on Google Sheets and Excel. Gets you the data that you need. So in this case, it's calculating the average, the median of these numbers, and it does a whole bunch of different calculations with the data to be able to determine the actual value of a company. So in this case, we're looking here, this is the earnings power value. This is the earnings power value per share. So this is what, according to this assumption, Microsoft would be worth. And if you look, this is the current share price or the market price of the stock. So in this case, there's a potential downside of 68%. This represents the difference in terms of percentage between the earnings power value per share, intrinsic value, and the current share price that you can see right here. So these models really help you speed up the process to be able to value stocks and recognize when they're overvalued or undervalued. And the last thing that you need to know is once you find the intrinsic value of a particular company, what's important is not to just make an investment decision right then and then, but to save the answer. I mean, you've already done the research for Microsoft, for example, in this case. You've already looked at the competitors. You've already looked at the market. You've already looked at analyst estimates. You've already looked at a whole bunch of information that allow you to determine this number. What's really important then is that you note this number down, put this stock on your watch list, and then that you watch that particular stock price over time because it's going to fluctuate, and that you take advantage, like you can see on this graph, of the stock price when it's undervalued relative to the value of the company. So what I'm going to share with you now is how you can accurately keep track of the stock price of a particular company right on your Excel and Google Sheet spreadsheet. So one of the best ways to do this, and we've actually made a video on this already that you can check out, a link is going to be left in the description, but you can use the wise price function in this case to get the stock data that you're looking for. So in this case, what we're going to be looking for is we're actually going to do a candlestick, and a candlestick is pretty good because it gives you a whole bunch of information that allows you to determine the market price of a particular company over time. So in this case, if we want to do this type of chart, I'm just going to delete this so you can see right away what kind of charts are available. So if you go on insert and then you select the waterfall chart, you will see right here that there's stock charts that you can access that are built in right into Excel. The one that I like the most is, it's either this one or this one. So we're gonna do this one actually right here, open, high, low, close. And with the wise price function, like I was talking to, all you need here is to enter the symbol. The parameters in this case is going to be the open, high, low, and then close. This curly bracket that you see allows you to enter multiple parameters. parameters in a function. And then the cool thing about this is that we can keep this number dynamic. So rather than saying for a particular date, although we could do that, you can see right here that there's a start and end date. What I recommend that you do is that you use this num days to end. So in this case, let's say that we want to get data for the past 50 days, for example. In this case, all we need to do is once we have the parameters, we have the data right here, you could close the function. And as you can see right away, you're going to date, the open, the high, the low, and the closed. So we're gonna just do this, copy, paste the formatting. So this is exactly the same. So in this case, we're gonna paste the formatting, great. And now we have all the data that we need to go ahead and create the chart. Cool thing about this again is you can change it to Microsoft because that's the company that we're analyzing. And now all we need to do is select the data that we have here, go on insert, and then we can go on the waterfall and we're gonna do, I believe we said this one, open, high, low, close. That's the one for us. And here is the stock chart. Now it's a little bit hard to see, so in this case you can make it bigger to be able to visualize the data better. You can also shorten the time interval. So in this case we could change it from 50 to like 30. And in this case, what's going to happen is that you're going to be able to visualize the data a lot better, a lot closer. So now what you could do with a chart like this is if you have a really good idea of the valuation of a particular company. So let's say that somehow using different fundamental measures, you determine that the intrinsic value of the company over this time period has been like this. And let me just make this a little bit bigger so that way you could see it. There you go. Then what you would do in this case, if you're a smart investor, is to keep track of the stock price. And then definitely what you want to do is not invest right here when the stock price is higher than the intrinsic value, but rather invest somewhere here where you can see there's a clear difference between the market price and the intrinsic value of the company. And this represents a good buying opportunity. Now you understand the concept of overvalued versus undervalued stocks, as well as some of the reasons why this may happen. The one thing that I want to leave you with is that as simple as this strategy may sound, this strategy has been extremely powerful for many investors out there. In fact, if you look at some of the most successful investors in the world, like the Warren Buffetts of the world, the Charlie Mungers, etc., they all follow this simple strategy. And the key thing here that you need to get better at is the intrinsic value calculation. If you can value companies well, then at this point, keeping track of the market price is very simple. So once you do this, then you're able to present yourself with many investment opportunities that you can consistently take advantage of over time and be able to grow your wealth. Now you know everything that you need to know about overvalued stocks versus undervalued stocks and how it is that you can take advantage of the constant shift of overvalued stocks and undervalued stocks in relation to the actual stock price of that particular stock. If you've enjoyed this video, make sure to subscribe and turn on the notifications on so that way you get notified every time we release a new video like this that's going to allow you to take your investing game to the next level. I'll see you in the next one.